Really? Yeah, fantastic. Oh, there we are. There we are. Okay. So I thought, since yesterday was Mother's Day, and it's a tradition, of course, to have Mother's Day celebrated in Las Vegas. How many of you think that's a great idea? All right. So anyway, this is an appearance that I had with Rick Santelli. I'm on his show about once a month, and I was talking about the mother of all bull markets, because despite the skeptics that we have here in our audience, we have seen, I mean, let's just show a hand with our four panelists. How many of you predicted that of all the bull markets that we've seen in the last 100 years, that this one was going to be the mother of all bull markets? Or did you think it was going to be the mother of all bear markets?
It still will be.
Well, I knew Peter would say that. All right, next slide. This will be for our introduction. See if we can get our next slide up instead of just, okay. Is the golden age of investing over? I want to show this chart because I did a little research on our speakers. I want to start with Gary Schilling. So Gary, Steve Forbes, in 2013, interviewed you for Forbes magazine. And you have been a long-term columnist and a good friend with Steve Forbes, and he interviewed you. And you made a very interesting statement that was made in 2013. You said that investing, if you started investing in 1981, which is where I've got it started here, 1981, if you invested in treasury bonds, you would have done better than investing in the stock market.
Yeah,
and this chart does show that, right?
Well, that's literally true, because we invest. The thing about treasury bonds, first of all, 10-year are notes. They are not bonds. Anything issued with a maturity of 10 years or less is technically a note. It's not a bond.
You were recommending 10 years.
And the thing is, the longer the maturity, the more bang for buck you get as interest rates decline. That's simply the matter of compound interest. So our interest is in 30-year treasuries, and that's what we use, our 30-year treasuries. And even more so, we use 30-year zero-coupon treasuries, which you get even further bang per buck as interest rates go down. Now, unfortunately, it works both ways. You lose a lot of money if rates go up. But those are the numbers that I cited earlier, and we have graphs and evidence we presented since 1981, showing if in October '81, if you bought, and we actually use a 25-year zero, because they didn't have a 30-year at that point, and if you had invested in that, and then roll it over each year to maintain the maturity or the duration, which is the same for a zero coupon, as you probably know. And then we compared that with investing in the S&P at its bottom in October of '82, and on a full return basis, the Treasury has outperformed the S&P by 6 times.
Okay, now let's go back to this chart. Okay?
Well, your chart is, you see, that's the problem. Most people say stocks outperform bonds because they don't look at bonds. They look at used to be the Lehman Index, Barclays Index. They're looking at a very, very short duration, short maturity bond index. And you just don't get much bang per buck as rates go down when you're on the short end of the curve.
Well, what
so people are loading the
Gary,
deck when they say that stocks outperform bonds.
Okay, look, all I want to show here is that in 2013 you were right. You don't have to give all your explanation and justifications on. I'm agreeing with you, okay? What I'm saying is, look what has happened since 2013. Stock market has roared, and while you've had slow growth, that would be the best way to put it, for your bonds. So my question is, are you ever going to turn bullish on stocks over bonds?
Well, hey, that's a good question, but I must say, you know, you can prove anything by picking the endpoints. In the economics profession, they call that growthmanship.
I was picking 2013.
You can prove anything. You pick the endpoints. If you want to pick stocks, look at the peak of 07
I picked 2013,
to 09.
Gary. I picked 2013. Now, I haven't seen an interview since then where you said, you know, at that point I realized that the stock market was the place to be. All I'm saying is none of us can be right on everything, right? So, next slide.
But let me ask you this: did somebody ring the bell in 2013 and tell you this is the time you ought to be?
I was hoping you were going to ring the bell. You know, I was expecting in this Steve Forbes interview you can say, but you know, we've had a great run. The 30-year or the 25-year zeros have been fantastic, but maybe, you know, it's a reversion of the mean. Maybe now stocks will have their day in the sun, but it didn't happen. But that's okay. All right, now the next one, we will turn to Peter Schiff.
Yes.
So, Peter, now you have been a gold bug for forever, as far as I know. Now, I actually have a gold coin
Yes,
in my pocket.
I know.
Where's your gold coin?
Well, I don't have one. You can give me yours if you want.
Silver? How about silver?
I carry it in my wallet, right? You know, I got my gold card, right? My gold money card.
Oh, okay.
So I got all my gold.
Yeah.
You know about that, right?
All right, let's go back to this chart. So my question is...
But look, just so I show you. See, this debit card is made of pure gold. You know about that, right? The gold money, right? I can spend my gold instead of big...
in Bitcoins?
No, not the real money, gold.
Real money.
Real money. Yes.
All right, so as the chart shows here on here, you've had a tremendous rise in stocks, in traditional industrial stocks, but gold, according to the gold mining index, they're pretty much dead in the water. Now, gold you have been predicting a bull market in gold. We haven't seen it yet, but what would it take for you to say, now is the time?
Well, first of all, gold's been in a bull market. It started in 2000, 2001. Gold was under $300 an ounce. It got as high as $1,900 in 2011. We know all bull markets have corrections, have bear markets within an overall bull market. We have been in one in gold until the Fed raised rates for the first time, and gold bottomed out at 1,050, and now it's about 1,325. But it had been in a bear market. I think that bear market has ended, and I think we're getting ready for the next bull market in gold. Those gold stocks, one of the reasons I moved to Puerto Rico is because I own a lot of those gold stocks, and I expect them to go up 10-fold, 20-fold, 50-fold. I don't want to pay any capital gains taxes, so that's why I'm over there. But you know, Gary mentioned earlier that he was very bullish on the dollar. One of the reasons that gold has had so much trouble was because a lot of people believed that. They thought, well, the Fed's going to raise rates. That's going to be great for the dollar. Well, the Fed has been raising rates, and the dollar has been falling. Last year was the first year in 5 that the dollar fell. It was the biggest drop in 14 years. January was the weakest January in 30 years for the dollar. So I disagree with Gary. I think the bear market rally in the dollar is over, and I think the dollar's going to fall. Chart. Yeah, and by the way, Gary, the Chinese don't have to sell their treasuries. They just let them mature. They didn't buy bonds or notes. They've got bills. And all they have to do is let them mature, and they're out. They don't have to worry about it. It's the dollar that's going to get clobbered, and I think it's going to be a big catalyst. What I think is going to really be the big mover for gold is when the Fed has to come clean and admit that the economy is much weaker than they pretend. They can't shrink their balance sheet. They can't normalize interest rates. In fact, they're going to go back to zero. They're going to do QE4. It'll be bigger than QE1, 2, and 3 combined. The currency markets, the gold markets are not prepared for that, but investors should be.
So our good friend Larry Kudlow, who's in the White House with Trump, Robert, he's in charge of the National Economic Council.
Right.
You like Larry?
He's a good columnist.
That's the best you can say for our supply side economist. He's just a good columnist. A good CNBC commentator more than columnist.
That's what I'm saying.
Yes, I know what you're not saying.
You know they banned me from CNBC.
Robert, I was interested in your Fed policies. One thing that Steve Forbes has been very bullish on is my statistic that the Fed is now, that the BEA is now adopted. And it's called gross output. And gross output measures spending at all stages of production. And GDP measures on the final stages. So as a result, consumer spending is overplayed. So do you look at business indicators as much as you look at consumer spending to see if there's any differing view of what's happening in the economy? Because it sounded like you were somewhat bearish on the U.S. economy.
Well, I guess it depends upon what your objective is. If you start with the perspective that there's some fundamental determinants of how fast an economy can grow, labor force growth and productivity growth, those two numbers added together give you a trend growth of real output of approximately 2%. You're looking at about 0.7% rate of growth in the labor force, and rate of growth of productivity is what, 1.4, 1.3, something like that. So that's a number pretty close to 2%. That's where we are right now, and that's a fact. I mean, and what do we do to improve it? Well, you deal with labor force issues. Pretty hard to do that, particularly with concerns about immigration and all that. So it boils down to productivity. And then the question is, are we measuring it correctly? Are we measuring productivity correctly or not? There's some people who think that we're not. I'm optimistic about productivity. I think if you look back in history, you'll see productivity going through different trends and different cycles. When you look around and see the kinds of interesting ideas, you've got electric cars, you've got all the technology that's coming on the line. It's just hard to be pessimistic long term, I think, about the productivity.
So you're not in the Robert Gordon, Larry Summers,
No.
Tyler Cowen, Peter Thiel, all of these secular stagnation thesis. You're not into that. I'm glad to hear that.
No. And just to answer your actual question, yeah, you look at a lot of different measures, not just one. And I just picked up consumer spending because it was so stark in terms of the change from we saw in the fourth quarter to the first quarter of this year. It's a puzzle, and particularly when people thought consumer spending would be buoyed by the tax cut and by the consumer sentiment numbers that we saw. That just was a surprise to me.
And my point is that gross output, which includes the supply chain, because GDP is just final output, and it does not include the supply chain. In the fourth quarter, the supply chain just took off. It grew at 8% in real terms. Pretty dramatic. And it suggests that maybe the tax cuts were more beneficial to business than they were consumers. That was my interpretation, and that's something I think we're missing with the data.
Well, I think that's also reflected in the business optimism statistics as well.
So I want to get into a different. Jim, you and Robert had two different perspectives on employment and unemployment. Jim, you were saying that we're entering a tight market, but Robert was showing a graph. I think it was you showing that. Job creation has really been rather pathetic compared to the past history.
And
so what's going on there?
Part of the reason for that, Mark, is that to create jobs, you have to fill them. I mean, you can right now you've got job openings at the highest level that they've been recorded in 20 years. There's a lot of companies out there that if you talk to anecdotally, and both in surveys, they say one of their biggest problems today at the manufacturing level or at the services sector in the ISM surveys, they say we cannot find qualified labor. Even if we can find labor, it's not qualified to what they do. How do you create jobs if you can't fill them?
So now, is this an argument?
That's not really a dichotomy, and there might be some disagreement here, but I think there's been an important transition over the last, I'd say the last 2 to 3 years in this economic recovery. The greatest risk in this recovery coming out of the Great Recession in 2009 was the possibility of a deflationary relapse, which would be a potential deflationary collapse. And if you look at the last couple of years, this recovery has evolved macroeconomically more into a traditional recovery that you'd have to go back into the 60s or 70s to see the kind of pressures that are emerging today. We have a very tight labor market. The ISM surveys are both up in the mid-50s or higher. It's very strong. It's very good. LEI has been hitting new highs throughout. You know, that kind of an economic recovery in a 9th year, or because we're in the 10th year of the bull market, but it won't become the 10th year of the economic expansion until after we go past June. But that kind of a scenario is one in which both investors and consumers are lulled into sleep. And they say, interest rates are not that unreasonable, inflation is tame. It reminds me historically of 1968 and of 1972. And we went through 1972 and into January 1973 when Alan Greenspan made this not so infamous quote. It's not well known. He said, "Very rarely can you be as unqualifiedly bullish as you can today." That was literally the same week the stock market peaked. And in 73, 74, what happened is the surprise was inflation crept up a lot faster. Yes, the jump in oil prices helped facilitate that. But if you look at those traditional economic cycles, I think where this one might evolve over the next year and where investors might look, watch for surprises. Don't look at the expected. Don't look at the anticipated or the forecasts and the headlines in the papers. Look for the surprises. The worst case scenario in this kind of an economic recovery is if inflation starts going higher than the Fed's 2%, 2.1%, 2.2%. And if we see more than 2 rate hikes this year, if all of a sudden the Fed starts talking about 3 more quarter-point rate hikes, then you've got that scenario of a 1969-70 bear market or a 73-74.
And remember, oil prices rising didn't cause inflation. That was caused by inflation. It was all the dollars that we created in the 1960s coming back to roost. Very similar to what we've done recently, only we've done it on a bigger scale. You know, oil now is at $70 a barrel. We could easily get back to 80 to 100 this year. 150, 200 is not that far off.
So let's take the next chart that I have, which maybe we need to look. Well, this is King Dollar, and as you can see, there's a double top there, and maybe we will see weakness. Gary, you think that maybe the dollar will continue to strengthen. This is kind of an average index. So you think that's just a bull market correction in the strength of the dollar? Gary?
I'm sorry?
I say, do you...
No,
I know we got caught up in the economic weeds and other topics, but pay attention. Gary!
I was trying to read the scale on that chart.
Yeah, so it suggests that the dollar's been somewhat weak this year, but you think it's just a correction in a bull market for the dollar?
Yeah, right? I think so. It's a safe haven. As I mentioned in my talk, the dollar has a lot of attributes of a currency throughout history which remains on top. And you know, one of the important things is what's the alternative? It's not the euro. There's still a question whether they're going to hold that thing together.
It's Bitcoin. Gary, it's Bitcoin. Come on.
It's not the Chinese yuan. That's a controlled currency. The yen, the Japanese don't want that to be an international currency. Sterling, that was the 19th century. I mean, you look around, what is the alternative?
So, Gary, I do want to ask you one question, because you said you were shorting the Bitcoin, you've made good money, right?
Yes.
You said that?
Yes.
But did you catch the uptrend increasing 10,000% on the upside?
I'm much more interested in corrections than rallies because they happen a lot quicker. And the one thing about a speculation is, you know, when you get to the point when the only reason that people are buying it is because it's going up. In other words, there's no logic.
Right.
It's all speculation. You know it's going to break.
Same thing is true for the dollar.
Nobody rings the bell when it's going to break. But when it does break, you know there's going to be a lot of losses, and they're going to accumulate a lot faster on the downside. Bear markets are always a lot more severe than bull markets. And so if you're if you're right on the bear market, I think you make a lot more money with a lot more certainty than you do on the bull market. When you started with Bitcoin at, where it was, I don't know, below $1,000, you have no idea where that's going to go because you were just beginning to suck people in.
Is there anyone on the panel here of this brilliant panel of economists and marketing people that made any money in Bitcoin, the greatest speculation in the last 10 years?
I wouldn't touch it with a 10-foot pole.
Nobody is more bearish than a sold-out bull.
My 15-year-old son made money
in the
it.
maxims of Wall Street.
It's easy to make money that way after the fact.
Mark, Bitcoin was based on the need for tracking transactions. Bitcoin was the outgrowth of the need of being able to have this permanent electronic ledger of electronic transactions. And that is going to continue on. In fact, you have some of the bigger shipping companies in the world that are using that infrastructure.
The blockchain.
Basically, the blockchain is going to live on. Bitcoin was the outgrowth of that. It became a speculative bubble outgrowth. And those who profited from it basically profited more by luck. And the problem is that it's backed by the full faith and credit of what?
Well,
that's the problem.
Are you describing the dollar? Because the dollar is not backed by anything other than the full faith and credit of what?
Yeah, but the dollar may move 5% maximum in a year. Bitcoin will move 10, 20% in a week.
Yes. And we haven't seen, look, one of these days the dollar's going to start falling 5% a day. I mean, Gary, you can go down with the ship if you want to. You may think there's no alternative to the dollar, but believe me, there are a lot of alternatives. One of them you have in your pocket, which is gold.
Yes. I'm the only one, by the way. The only one.
Right, but no, I've got lots of gold in my pocket. It's just in my wallet. But the internet, people were initially attracted to Bitcoin because, I first knew about it when it was $1, $2. I mean,
why didn't you buy it?
Because I outsmarted myself. That's why. I should have just bought it, right? Obviously, right? But I would have sold it by now if I'd have bought it. But the reason that people initially were attracted to it is people used to say, well, you can't buy a cup of coffee with gold, but I can buy a cup of coffee with Bitcoin. Well, now you can't. It costs more than a cup of coffee to use the Bitcoin, but you can actually buy a cup of coffee with gold. You can actually spend gold, save gold, transact in gold. I think the world is going to move back to gold when they're looking for alternatives to fiat currencies. I don't think the cryptocurrencies are going to work, but I think gold has worked for thousands of years. It'll work even better now. And you talked about this, why the economies aren't growing the way they should be. They're not growing because of central banks. They're not growing because what grows an economy is underconsumption. Savings are the key to economic growth. That's what provides for capital investment, productivity. When you have interest rates near zero, when you have governments running massive deficits, you undermine savings and you undermine economic growth. And so we're not going to get back to a faster growth until we rein in government. And that's not going to happen under this current system.
And speaking of policy, so we need to end with this one last view and perspective. I did have another graph talking about maybe it's time for emerging markets. They haven't done too much, although they're starting to move up. Maybe that's, I know that's one area Peter gets into with his own funds, non-U.S. companies. Do any of you see you've all seemed to be very cautious about the U.S. market. How about emerging markets or international markets? Is there opportunity out there?
Yeah, I think there's tremendous opportunity in the emerging markets, specifically for the opposite reason of what Gary said, is that a lot of these countries have a lot of U.S. dollar debt. And so the strong dollar undermines their economy because it increases their debt burden. But as the dollar goes down, it's like their debt is wiped out. And also you have a lot of commodities that are priced in dollars. And so when the dollar weakens, everybody else gets wealthier because now their cost of living comes down. So the emerging markets will benefit dramatically from the decline in the value of the dollar. It's going to wipe out their debt. It's going to reduce their cost of living. It's going to make energy less expensive for them and food, all the basics. So, and if you look at the relative valuations now between the emerging markets and the developed markets, they've never been this cheap.
So there's been a study of the last 100 years called The Optimist, The Triumph of the Optimist. And they did this study, and Warren Buffett referred to it recently, saying of all the markets around the world, which market has done the best over the last 100 years? And the answer is overwhelming. Yeah. America is exceptional. Yeah. And will that exceptionalism continue into the next 100 years when we're not going to be around? Let us thank our panel, Peter, Robert, Jim, and Gary.